Hello everyone, welcome as usual. Just a quick sound check and video check. Okay, so looks good, thank you. So welcome everyone. I know that we have members of the Gamma Optimizer room and also the main room, the presentation today. So let's start and see what we have in store for today. So I'm going to go a little slower in terms of the concepts, just to accommodate people that are not familiar with the format. So please be patient. And as usual, just before I start, remember that you can ask questions at any time. You can interrupt me and I'll try to answer the questions as soon as I see them here on my questions window. Okay, let's start. What do we have for today? Let's look at the close positions from the room. Yeah, so we are doing the new BRP 350 system that trades at about 3 times per week. And this week we have 2 winners, and it looks like we're going to lose today. Might or might not. You know, the market is moving so much around the threshold of winning that it was winning 10 minutes ago, now it's losing. So let's assume it's a loser. But even if it's a loser, the system is doing really well. I'm glad that the system is working well and it's performing really well. In particular, it performed really well in February, and it's performing well in March too. So I'm happy with the system, and I'll continue doing it. Okay, so in terms of market regime, let's look at the GT level. The GT level is at 4,443. For those of you that are not familiar, the GT level is a level of neutrality. It's the gamma threshold level. That's the GT means. It is some kind of ideal point that if the market for some magical reason is at that point, then option dealers of S&P options don't have to do any hedging. It's a point where if the market is there, the total gamma exposure is 0. Okay, so when the market is above the level, we say that the market is long gamma, and when the market is below the GT level, we say that the market is short gamma. So right now the market is below the GT level. In fact, it has been below the GT level for the whole year. It has been below the GT level for most of 2022, almost all 2022. So this is the 3rd month of short gamma. And just to provide some context, the last recent time that this happened was during the COVID crash in 2020. We spent almost 4 months in short gamma. No, but of course we have a massive crash and the market was in dislocation mode. But now the market just organically flipped short gamma and doesn't have the energy to come back to long gamma. And if you want to look for periods of extended short gamma behavior, you have to go all the way back to probably 2008, where the market spent short gamma the whole year, between 2008 and 2009. And of course, at that time, we have the bear market of the financial crisis. So not a good start for 2022. The market really seems to be really weak. And an extended period of short gamma, to me, is an early sign of a bear market. It's not like I am putting the stamp of a bear market right now into the S&P 500. It's just saying that it's an early sign. No, I'm still holding hope for a long gamma flip at some point. I think I am optimistic. So let's see if it happens. If the market continues short gamma for a full quarter run, that's going to be interesting. We have to reevaluate a lot of positions. Okay. The main takeaways of a short gamma regime is that volatility is very elevated. And I'll explain to that later on. When we go at the variance center, I'll explain why volatility increases during short gamma. And also, another signature of a short gamma regime is that the price trends down. That's what it is. So there is a main price trend which is down, and then you have bounces along the trend. But the trend is solidly down, and we have been down since the beginning of the year because we have been short gamma. So for those of you that are really looking for a massive long positioning, and for those of you that have a long thesis, I think it will be prudent to wait until the market fully flips short gamma, which is not that far away. I mean, it's only 140, like 35 points away. It's like 2.5–3%. And given how the market moves, you can have a flip in 1 or 2 sessions. Now, if the market is moving 2% per session or 1.5 per session, it only takes 2 days of trading for the market to flip long gamma. But let's wait until the market flips long gamma, and let's wait until it's convincing, and let's wait until we are long gamma at least for 2 or 3 sessions, and then we can start talking about like the next leg up in the market. For now, I don't see it. For now, any bounces are suspect. Any bounces are going to be treated as selling opportunities, and that's what it is. No, that's kind of my thesis. Also, the good thing about the GT level is that it gives you a window of near term. For me, near term action is anything between 1 to 5 sessions. Okay, so I'm not talking about the next 3 months or 4 months. I'm talking about like Monday. From here until the next Friday, basically, that's what I'm talking here about the short gamma downtrend. Of course, I have to mention geopolitical noise. It is pervasive. Market seems to be reacting real time to any tweets or any news that come into the wire. But for those of you that have been looking at the markets for a long time, you know that this is gonna end soon. I mean, the market moves on into something else. The news cycle moves on into the next big story, and as the new Fed meeting approaches, you will start seeing that as a more relevant narrative. So hopefully the geopolitical noise is dying down. And in fact, this week it seems that the noise is dying down. I mean, the noise is still high, but the reaction to the noise is dying down, and I'm going to explain why it's going down a little bit. So it has this feeling that the market is tuning out the noise, and it might happen sooner than you think. So that's in terms of the market regime, in terms of the GT level and how we are positioned. In terms of volatility, and here is the explanation why I think the market is starting to tune out geopolitical noise. You can see that the realized variance for the last month is really elevated. It's 23.4%, which is actually very elevated, but not as elevated as it has been this year. The same for the past week. In the last week, we have a annualized realized variance around 20.84, which is also very high, but lower than what we are seeing. So this makes recent action to look calm. You know, the market actually looks stable if you compare it to the way it had behaved in the first 2 months of the year. No, so volatility, absolute levels of volatility are very elevated. However, it seems that the market is developing a pace already, and whatever is the geopolitical noise is starting to have little effect on the volatility of the market. It's elevated, but it's not inducing extra volatility. Okay. The good thing is that VIX is very elevated. And why is that a good thing? In particular, for those of you that are not members of the Gamma Optimizer group, it's good because the whole year, and I had been saying this since probably September of last year or October of last year, option dealers had been mispricing volatility. They had been wrong about volatility. They were wrong for the last part of this year. They had been wrong consistently all year long. And finally now, VIX is at a level where there is a decent variance risk premium. Variance risk premium is measured the way I measure it, just to provide a quick overview of it, is just the difference between VIX and monthly realized variance. So if you have a monthly realized variance of 23.4 and VIX at 32, then you can see that we have around 9 volatility points of overpricing, which is actually good. VIX was actually really close to the monthly realized variance. Like, dealers were so optimistic, and I don't understand why. So it's good to see that finally options dealers are starting to use current risk for option prices versus future risk. I mean, they had been pricing options with all these very rosy and optimistic expectations of volatility, and they had been wrong. And I'm pretty sure they are losing money, like lots of dealers are losing money this year, because remember that even though they hedge price risk, they are exposed to gamma risk. And if they are mispricing volatility, then they are suffering gamma losses, and they have been suffering gamma losses this year, and you will see a little later. So with VIX at 32, at least they are trying to cover a little bit that risk exposure. And that's good because it opens the door to different types of trading. No? And so that's what is good to see VIX finally reacting. I hope that they they keep it around these levels for a while until we start to see liquidity in the market again and until we start to see a long gamma regime again. Okay, so let's look at the term structure, and this ties with the previous slide. So just a quick overview what this chart represents. This chart represents every expiration of the S&P 500, and instead of putting like July or August or the months, I am just putting the days to the expiration. So you can see in terms of days. So I am just showing the first 200 days to expiration. And the blue line is, oh, sorry about that. The blue line is the VIX computation for every expiration. So this is the implied variance at every expiration. The red line is the same thing on last Friday. So we can see how it has evolved from last Friday. So you can see a couple of things here. You can see that there has been a massive repricing of volatility across all of the term structure, across every expiration on the S&P 500. What this means is that finally dealers recognize the extreme circumstances where the market is trading. The market is, dealers are finally recognizing the lack of liquidity and the complete total uncertainty. This is, I jokingly refer to this particular configuration when you have a flat term structure and a near-term inversion. For those of you that know me, you know that I refer to this as the end of the world configuration. So my option dealers are actually pricing volatility as if Western civilization is going to end. Oh, and I have a question. Leo, is there a way to determine each week the amounts and day and times the retirement funds enter the S&P 500? How do retirement funds enter the S&P 500 index funds? Oh, that's a great question. Let me finish this slide and I am going to provide a little insight into that. Okay, so let's look at volatility, and then I'll talk about when the inflows to the market arrive. Okay, so in terms of volatility, you can see that dealers have no idea what is going on. A flat term structure means that I am worried and I don't know where I am going to stop being worried. That's what it is. You know, when you see a flat line, it means that the guys see tremendous amount of risk. They don't know where. They think that something terrible is going to happen to the market, but they don't know when is going to happen to the market. And so the whole term structure flattens. And this is what we have today. Of course, last week it was almost flat. And I mentioned in the meeting that it was getting close to flat. But look at the tremendous difference in the levels. Last week we were like 26, 25. And this week we are 32, 33, like 6 full volatility points in a whole week. That's a massive amount of overpricing of volatility. The near-term inversion that you see here, this represents options expiring today, the first dot, and options expire on Monday, Wednesday, and Friday. You can see that there is inversion used to cover weekend risk. No, like you don't know what is going to happen over the weekend. You guys know how crazy everything is in the world right now, so anything could happen over the weekend, and that's why you have this inversion. But more than the inversion is the flatness of the curve. Not only the flatness, but you can see this bump here in the next 10 to 20 days. That bump represents the Fed meeting. So dealers are now concerned about everything, are concerned about the Fed meeting, and they are concerned about unknown risk to the market. So I think, to me, I think this is good. I think it's good when dealers finally price this, because then most of the time they are wrong. So hopefully the world is not going to end, and hopefully this overpricing is just an overreaction, but at least it is. I'm glad that it's happening right now. And this opens tons of opportunities, folks. I mean, for those of you that like to trade volatility, the fact that the curve is this opens tons of probabilities or possibilities, because you know that during normal times, the curve is in contango. It's just a nice sloping upward line. And then there are many types of trades you can design if your thesis is that we eventually are going to go back to that, okay? So in any case, it looks like everyone is panicking a little bit in terms of volatility, and I like it. Now, coming back to the question is if there is a way to know when retirement funds like mutual funds or investors come into the market, do they come at fixed times? So most of the time, the answer is yes. They tend to come around pay cycles, because most of those funds are finance. When you work in a company, you get paid a salary, you get paid bi-weekly or whatever it is that you pay, and some people contribute a portion of that into those funds. So you tend to see spikes of buying around those dates, no? When there are the contributions from salaried workers. So that's when you tend to see inflows into the market, no? That's the usual upside drift we see in the market is due to people contributing to their 401ks or the IRAs or Roth IRAs. And it tends to happen twice a month. At the exact day is hard, funds receive the money and they are doing it, I think, most through the whole month. They try to spread purchases through the whole month. But mostly we'll see this happening on Fridays and mostly around 4 p.m. So during the day, you want to pay attention to these inflows. You can see it around the closing auction. That's when you can see this. And usually on Fridays is when you will see even more, or even early Mondays, you can also see that. That's the answer to the question about the inflows. Okay, so this in terms of the tournament structure, we have end of Western civilization price. Let's look at intraday realized variance. Intraday realized variance is a quantity that I like to measure because it's a good proxy for liquidity in the market. So in this chart, intraday realized variance is the blue line. Okay, for the S&P 500, for the S&P 500, which is what we track in the Gamma Optimizer room, we have a magical level, which is 10%. 10% is this line here between 0 and 20. When the market is below 10%, that means when the blue line is below 10%, those are periods where like plentiful liquidity. I am plotting here this since the COVID crash, and you can see that early in 2020, liquidity disappeared because liquidity is inversely proportional to realized variance. Realized variance was below 10, so plenty of liquidity, and then realized variance jumped to 80, and that means no liquidity in the market, and then the whole 2020 was crazy. Then 2021 was a little crazy, but it started to cool down around the middle of the year, and then it got crazy again in 2022. So I just want to show you how 2022 looks really bad in terms of liquidity. Intraday realized variance since the beginning of the year has been bad. I mean, if you notice this chart, there has been probably just one session or two where intraday realized variance was below the magical 10% line. Most of the year, the intraday realized variance has been substantially elevated, which is consistent with a picture of liquidity disappearing from the market, and also is consistent with a short gamma regime. What do I mean by liquidity? The markets have a very important set of participants that are liquidity providers. Those are the guys that actually do the trades against you. When you buy Apple, or when you buy Tesla, or when you do Amazon or whatever, you don't get another person like you on the other side of the trade. That's a misconception, okay? When you buy things in the market, be options or stocks, I will say that 99.99999% of the time, the person on the other side of the trade is not a person. It is a computer. It belongs to a highly specialized firm, and they are liquidity providers. Those are the guys that provide liquidity for the market, and they take your trades. Now they are paying Robinhood for them. They are paying TD Ameritrade to get, and they are paying Interactive Brokers. They pay good money so they can trade against you. So those liquidity providers had been really drying up liquidity. They have not been that willing to provide liquidity in 2022, and that's what you get. That's why you get these gigantic values of realized variance. That's why the market is so volatile, because they are not willing to step in and provide stable prices. They are moving the prices all over the place, and the market is moving all over the place. So one of the reasons I think that is happening, I mean, the geopolitical noise, if you really have a cold head, you realize that net exposure of the S&P 500 to the situation in Russia and Ukraine is very low. There is almost no exposure to it. In fact, I think net exposure of any company to the Russian market is very low. And the same with Ukraine. I mean, what is the net exposure of the S&P 500 to Ukraine? So the direct exposure to the conflict is very low, yet we see impacts in liquidity. And the reason is that we are experimented market dislocations. Due to the conflict, there are several markets that completely disappear. I mean, there is no market for Russian debt in this moment. No one buys or sells bonds. There is no market for Russian shares. And there are plenty of ETFs that are holding those shares. There are plenty of big funds that are holding Russian debt. And these markets are not illiquid. The markets disappear. Okay, there is a difference between lack of liquidity and the whole market disappearing. And I think that that's percolated into the S&P 500. I think the intersection between institutions that are exposed to these liquid markets and the institutions that are exposed to the S&P 500 is bigger than we thought. And this lack of liquidity in this foreign market is percolating into the US market, which already have terrible liquidity since the beginning of the year. So it's making things even worse. The thing is, this is just overreaction, and eventually everyone will realize through exposure, everyone will realize they will either write down the exposure to zero, they will figure out ways to get rid of the exposure, and then some measure of liquidity and normalcy will return to the market. That's kind of my thesis. Probably in the next couple of weeks that will happen. But still, in terms of realized variance, things don't look good. I mean, 2022 is a terrible year. It is really, really, really bad in terms of liquidity and realized variance. I have here a question. It seems that liquidity providers are only providing liquidity when they feel like it. Another time, they seem to be quick to turn off their provided liquidity. As a result, we are seeing the higher RV. Will that be a correct way of thinking in general? Yes. Yes, I mean, of course, the market changed a lot. You know, for you guys that have been around for a while, you know that we used to have market makers, like designated market makers. But we don't have them anymore. No, they disappeared. There is no such thing as a designated market maker. Liquidity, people that are providing liquidity are doing it because it is a good business for them. No, so they are not mandated to provide liquidity. They are not forced by law to provide liquidity. They provide liquidity whenever it's convenient to them, and that's why we have this terrible situation. Modern markets don't have that model of designated market makers anymore. Modern markets have liquidity providers that are just highly efficient, really fast, high-frequency trading firms. And the problem with that kind of liquidity is that you cannot count on it. You know, that liquidity only arrives when it is convenient. And then if there is something is bad, then the liquidity disappears, and that's what we're seeing. And so you are correct. We are seeing that effect. And it is sadly an effect of how market microstructure has evolved with time. No, maybe through regulation we can go back to the old model, but I doubt it. I don't think that. As long as in the US, as long as it is legal to pay for order flow, we'll continue with that model. If for some reason the US bans order flow payment and people cannot purchase it anymore and cannot buy it, then we might return to a designated market maker, designated liquidity provider model. But I am not counting on it at this point. Okay, so going back to realized variance, terrible look in terms of realized variance. In terms of variance risk premium, so here it is. The red line represents the premium that option dealers are actually extracting from the market. And of course, a red line above zero means that they made money on that extraction. And if the red line is below the zero level, they lost money. So you can see here, for instance, that in 2020, of course, with the COVID crash and no one had a crystal ball, they lost money for a few months, and then they kind of started making money again. Most of the time, you know, they became really good in 2021. And now in 2022, they are being burned. Notice how it has been below the zero level for early on this year, and this week is again below the zero level. What does this mean? This means that option prices were not correct. That means that dealers didn't correctly price options. That means that most dealers lost money, no? In particular, in the tail risk section. So that means options that are out of the money, it means that they were losing money there. And in this moment, they lose money here. And it happened to us. We got caught here at the beginning of the year a little bit with our system that it was a tail risk type of system. but we stopped doing it, and then that's good. I mean, the good thing about they lost money, but the good thing is we are not doing the system anymore. So only recently, and by recently I mean the last couple of sessions, dealers have been pricing again volatility correctly. So my expectation is that for the rest of the year, this red line is going to start increasing, like what we saw here at the second half of 2020 when it shot up to the, really high. I think that pretty soon this line is going to shoot up, because I don't think that dealers are in the business of losing money. So they are going to start repricing pretty soon. I mean, they already did, and they will continue repricing. And this is a good lesson. I think that whatever it is, the mathematical models that were used for pricing risk were completely wrong. No. So that's good. That happens once in a blue moon. They have to reevaluate, they plug the models, they reprogram the machines, and we'll get a better PRP. Of course, this is if we don't get a full-blown global conflict. No, I mean, this is like assuming that the world will go back to some sense of normalcy at some point. And I have a question right here. Let's see what the question is. The question is, will it be correct to say that right now, with the higher volatility and reduced liquidity, that there are good opportunities to short well chosen out of the money puts right now in specific equities? Yes, I mean, that's a good question, Ron. There are ways. What you're implying and what I am trying to say is that yes, variance risk premium extraction will be a good play, and this could be a good moment to play it if dealers can price options correctly. No, I mean, I could have argued for that around this point here at this low, but notice that they reprice them a very little and then they misprice them again. So if they can consistently price options, then yes, there is going to be a good BRP option extraction, and you can extract BRP through many ways. I mean, selling out of the money puts is a way to do it. And there are other ways, like when we do in the gamma optimizer room, we do it in a slightly different way. But yes, in general, I think I agree. It is a good opportunity right now to start preparing a good strategy, a systematic strategy for selling variance risk premium. But of course, monitoring the situation, because if we go into a full global conflict, forget about it. No, like this is it. And then I have another question. A couple of days ago, you mentioned that the market was flipping between short and long back and forth, and took a bullish trade at the end of the day, even when the GT level was in short gamma. Could you explain why you have taken long trades in short gamma? A great question too. I mean, short gamma means a main trend that goes to the downside. It doesn't mean that the market is going to fall in a straight line. No. Short gamma, you get violent bounces, as we have seen. Like the last couple of days, we got this massive bounce and now down. And so the market is really fertile for doing trades that exploit this massive move. So in general, a good rule of thumb is that in a short gamma regime, if the short gamma regime is increasing, then it becomes really attractive to do long gamma trades. No? So notice how it's the opposite of the regime. In a short gamma regime, because the market moves so much, then it is attractive to do trades that exploit the massive move. So those are kind of long gamma trades. So that's why I trade up or down. I mean, I like to trade up. And the system that we use in the room is the 350 system, which is just a it's a machine learning type of system that tells us if we go long or short. But it is really good to pick a direction, because if you are right, the thing is going to move. The market is not going to move 5 points tomorrow. The market is not going to go down 10 points on Monday or go up 10 points. The market is going to move 40 points. So, it's going to move a gigantic amount of points. So doing directional trades, it could be really good, in particular if you pick the direction. So the reason I went long is because that was the system told me. No. And that's how you play it. You don't know if the market is going up and down, but you play the opportunity. Okay, so that was in terms of variance risk premium. Let's say in terms of ambiguity. So ambiguity is another statistical measure of the market. It's very related to volatility. It's kind of the volatility is the variance of implied volatility, I guess I will say it. So in a sense, it hasn't been a factor since last year. No, since probably August of last year, ambiguity hasn't been a factor, and it's not a factor. It has been low. Whatever is happening in the market is not related to ambiguity. It's related to other things. to lack of liquidity, is related to inshore gamma, is related to the switching to a new era of quantitative tightening as opposed to quantitative easing. So the ambiguity is not a factor. For those of you that are not part of the room, I know you're very curious about what it is. I will be more than happy to discuss this outside, but like, I guess the main takeaway is that it's not a factor. There is nothing here for me to say. I only include the slide for completeness because I know there's some members love to see this, but it's not a factor at all. Like whatever is happening is not connected to ambiguity. So finally, about the trade plan. What is the trade plan? Okay, so the trade plan is to continue the BRP 350 trades, which have been going really well for the new version of the neural net. Is doing really well. You know, it actually made money in February and also made money in January, which is surprising. So I like it. And also, given how variance risk premium is behaving, I think on Monday, because I am not willing to take a weekend risk, but I mean Monday or Tuesday, I'll plan to start again the 320 trades. So we'll see. So that's kind of the trade plan. Let's look at the variance center quickly because I'm taking longer than usual. So this is the variance center. And you can see all those things here. You can see the GT level. You can see that we are short gamma. And to me, something that I really like to look at is at the gamma imbalance. The gamma imbalance represents the amount of hedging that has to be done if the market moves. So for instance, if the market for some reason moves 1%, which in the current environment is 45 points, no, 43 points. If the market moves up 43 points, that means that dealers have to add longs around 25 billion of notional in longs. So they have to buy, okay? So notice this, the market is moving up and then dealers have to buy. So what happens here is that dealers are accelerating the move. If there is an organic move up, dealers are actually adding to it, and 25 billions of notional is not that. It's not a small number. It is a decent number that can have an effect on price. And that's one of the reasons that you see these massive moves, because they are doing buying if the market moves up. The same happens with the market moves down. Now we have an imbalance down. The imbalance down is actually higher because it means if the market moves down 43 points, dealers have to sell. You know, they have to add to shorts around 34 billion, almost 35 billion of notional short selling, and that's a massive amount of selling too. So no, it doesn't matter what the market does, dealers are exaggerating those moves. So that's what a short gamma regime is. In a short gamma regime, you see these values have these moves up, have positive sign, moves down, have negative sign. If someday we flip long gamma, and you look, you'll notice that the signs reverse. No? So that's why in long gamma we have low volatility, because dealers will have to hedge against the market. But right now dealers are hedging with the market, and they are increasing, they are amplifying the moves. Okay. In terms of realized variance, it is elevated, not as elevated in other days. It's almost 18%. This is the realized variance for the whole day. Remember that for a normal day in the S&P 500, the magic number is 12%. Now 12 is the magic number for intraday realized variance. So clearly we are substantially higher than 12, and that favors downside. When it's so elevated, it means liquidity is not present, and the lack of liquidity favors downside action. Okay. And this chart, this gamma imbalance chart, for those of you that are curious, represents the same numbers. The numbers that we have here are represented in this chart. No, the only difference is that the numbers are represented across strikes, different strikes. So here is like a total number. Oh, if the market moves down, dealers have to sell a bunch of notional, but most of the selling is concentrated around certain strikes. For instance, 4,300, 4,200. You can see where most of the gamma in the options is right now. So this is the downside gamma in options. And notice that there is very little upside gamma. It's almost no upside. There is very little upside gamma. So yeah, so there is a dominance. Puts are dominating right now in terms of gamma imbalance. And just to finish the presentation, we can move to the neural nets. And we have a trade today. We have potential trade that right now is bullish, but it's about to flip bearish. Notice that the probability is 48.59. Remember that if it's 50 or more, it flips from bull to bear. So we'll see. You know, right now it's kind of bullish, but it can flip really quickly. So I don't have any. I don't plan to front run this trade ever today. And also remember the strikes change real time. So who knows what the strikes will be by 4 p.m. So better to wait until 4 and see if it's bull or bears. Right now it looks like it's slightly bullish. And the neural net ultra has been a little pessimistic for several weeks now, and we are seeing the pessimism now. Also ultra has been predicting tremendous amounts of volatility. Like this is like huge amounts of standard deviation, and I think we are getting it. No, I think we are getting this volatility today. So that's it. I mean, I plan to do the VRP 350, whatever it is that we finally get, and I will be, even if it's long, I'll do it, but I'll do it with like small size, being really careful, being mindful of what the current regime is. Okay, everyone, I guess I went long a little bit from the allotted time. I really appreciate you guys joining the presentation. Also, thank you very much for those of you that are part of the main room. I hope you got a little bit a taste of what I do in the Gamma Optimizer room. You're always welcome to stop by and ask questions. I'm more than happy to answer. So thank you, everyone, and I hope you have a great weekend. Oh, okay, I have a couple of questions. Will this be recorded? Yes, it's always recorded. I'll try to find a way for this to be posted publicly. What is the difference between the two VRP systems? Oh, well, I mean, there's plenty of difference. Let's go back here and briefly explain the VRP system. VRP 350 means that it's a trade that is 3 sessions away and is around the 50% binary level, no? Which is a level that is 1-to-1, that you risk $1 and it pays $1, no? So this is this trade in particular. The VRP 320 is a different system. It's more like VRP extraction, variance risk premium extraction. It's 3 days, but it's only the 20% binary, which is a system that you risk $1, you risk $4 to make one. You know, so it's substantially risky. So it has more risk, but it has more probabilities of winning. You see, while this system is pretty much even money. Now you are risking 2.5 in order to make 2.5, but the thing is you are winning more than half of the time. So in the long run, you're making more money in the system now. So the system has around 70% success rate right now. So, and it should only succeed 50% of the time. So it's making some money. The same with this system. The system should succeed only 80% of the time, according to the pricing, but it's succeeding around 95. I mean, in February, of course, it was terrible, but in general, that's kind of how it is. It works. Okay. And I have a couple of questions. VRP 350 has seemed to be right around 50% with the potential to flip for the past couple of weeks. Is this common? No, it is not common. I mean, this means that our neural nets, for some reason, are approaching what dealers are pricing now. Most of the time, we tend to price options better than dealers, but it seems that right now, when you get the probability around 50, it means that we are agreeing with the dealer somehow. No? so by magic, our system is kind of pricing options more or less how dealers are pricing, but that's not the situation most of the time. Okay. Okay, everyone. Okay, thank you for your questions, and please feel free. You can ask me the questions in the main room or on my room, and everyone is welcome. Again, have a great weekend, and I'll see you a little bit on the room. Take care, everyone.